Trump just released the new tax bill that is moving its way slowly through Congress right now.
On this vote, the yeas are 215, the nays are 214, with one answering present. The bill is passed.
Hi, I'm a CPA. I've been doing this for 45 years, including years in the National Tax Office of one of the big firms in Washington, D.C. I'm going to break this down for you, just how it is now. The most important thing to remember is this will change. So what I'm telling you is going to change. The most important thing about this new tax bill is it retains the tax rates from 2017. In 2017, everybody got lower tax rates. It wasn't just the rich, everybody got lower tax rates. In fact, most of this bill is really to continue the policies of 2017. So that's all a good thing. That's most of the bill. There are some new things, better things, and there are some worse things. And so let me break those down too. So let's talk about some of the good things. First of all, the bill brings back generally bonus depreciation. Now, bonus depreciation means you get to write off your equipment now. Okay, you buy new equipment, you buy new furniture and fixtures for your office, you get to take that deduction today. You don't have to spread it over 5 years or 7 years or whatever. You get to take the deduction today. And that can either be done through what we call bonus depreciation, or we also have the 179 deduction, which a lot of you have heard about, and that actually increases. So that will apply to more companies and to more equipment, Section 179. It's almost doubled. Another thing that's changing is the research and development expensing provision is coming back. That's a big deal. There are companies that have been paying an effective tax rate of over 80% on their cash receipts because they didn't get to deduct their research and experimentation costs. Now you're going to get to deduct those. Now, what we don't know about either bonus depreciation or research and experiment deductions is, are we going to get those forever? Is it going to be made permanent, which we hope it will be, because those are two really good provisions, or it's going to be just for 5 years. In other words, it'll be till 2029 when the next administration has to deal with this. It would be much better to make it permanent. And by the way, the rumors on the Hill are the Senate is really trying to make everything permanent. They do not want these temporary tax changes anymore.
Every individual tax rate will be made permanent.
And I'm really happy to hear that. There's a little known item in this bill that I really like. I think it's funny. It's called the MAGA deduction. What it is $5,000 deduction every year for families or parents to put money into basically a savings account for their kids, and it can be invested in the stock market. It can't be invested in anything else. Got to be like an index fund, something like that. But the $5,000 is for minor children. It can be invested, and then it can be taken out tax-free if it's used for one of three things. So additional education after they turn 18, or for a first house, which I think is terrific, down payment on a house, or what I think is even the best part of this, for starting a new business. So this is an encouragement to young people to start a business when they get out of school, and really not just make it higher education, like all the education credits, but actually give parents an incentive to do something for their kids beyond going to college, actually where they might actually go to a technical school, which would also qualify, or they might start a business, or just buy their first new house. Would need to be spent by the time they're 30. Otherwise, there's penalties on it, which I think that's good too. It gets kids going, gets them out of the house. This is all good. For those of you who are parents with kids that are over 30 living in your house, you're probably excited about this one. That's, I think, a really neat provision. Now, there's some other provisions like increasing the child tax credit, odd provisions you probably heard about, like there are penalties for sports team owners, things that don't affect you in your daily life. Some of the things, the way they're paying for this is they're reducing so-called clean energy credits. They're eliminating the $7,500 credit for electric cars. They're phasing out credit for solar and renewable energy installations. We know that's going to be phased out. We don't know when it's going to be phased out. If you're interested in putting solar on your home or on your rental property, best do it now. This is the time to do it. You want one of those electric cars, best do it now. Now, there are some provisions in the bill that aren't so good, frankly. The worst one is the increase to the state and local tax deduction. Why is that bad? Well, first of all, there's really no good policy reason for it. They're just trying to buy votes. There's really no good policy reason for increasing state and local tax deduction. On top of that, back in 2017, when it was eliminated or limited, most people didn't even get the state and local tax deduction because they had an alternative minimum tax, which prohibited them from getting it. Now they want it back, but without the alternative minimum tax. There are people in Congress, in the House, in California, in New York, in New Jersey, in those high tax states that want the rest of us to subsidize their high tax payments, and only for the rich people. By the way, the high standard deduction is made permanent under this bill. With a high standard deduction, most middle class people do not get the state and local tax deduction anyway, even if they are in a high tax state. This is where it doesn't make a lot of sense that they're doing this, but these Republican congressmen are holding out for this, and they're basically holding the bill hostage over this. So we'll see what happens with the state and local tax deduction. I think it's a terrible policy. A couple of other things that I think are unusual, but not surprising when he was campaigning for president. One is not taxing tips. That's limited to a certain level of income, but it's a pretty high level. Right now it'd be about $160,000, but it is limited. So in other words, if you're making $300,000 and you get tips, and it's also limited to certain traditional tip industries, food industry, hotels, hospitality, things like that, hairstyling, etc., things where tips are common. Although these days, everybody asks for a tip. So who knows? That'll be an interesting part of what ends up in the bill. Another one is no tax on overtime. It's that same $160,000 mark goes up with inflation. That's also limited to those people making $160,000 or less. No tax on overtime. By the way, this is an interesting one. The car interest deduction is applicable to cars that are finally assembled in the U.S. They don't have to be entirely made in the U.S., just finally assembled in the U.S. And it is not part of your itemized deductions. So you get to take this deduction even without taking itemized deductions. That would be a boon for anybody buying a new car, paying interest on their car. Those are kind of the basics of this new tax bill. But remember, it's just come out of the House Ways and Means Committee. Then it has to go to the floor of the House. And there are lots of things that can change between now and when it's voted on by the total group. Then it has to go to the Senate. The Senate has their own ideas. It goes to the Senate Finance Committee. Then it goes to the full Senate. Then it ends up reconciliation, which is the joint Committee on Taxation. This is a few people from the House Ways and Means Committee and a few people from the Senate Finance Committee, and they get together and they decide what the final bill is going to be. Then they take it back to the respective houses, the House and the Senate, and they vote on it. Once that bill gets voted on, then it goes to the president for signature. Now, President Trump is anxious to sign this bill. He just wants him to get it done.
I don't know how Democrats can't vote for it. If they don't vote for it, they're talking about a 68% tax increase, which is ridiculous.
It's a very important bill because here's what's going on. Remember, we've got these tariffs, and tariffs are a brake because they're a tax too. They're an increase in taxes, and tariffs are putting a brake on things right now. When you have a brake, and the tax bill is an accelerator. Remember, on your car, you've got both brakes and you've got an accelerator. You've got to have both in an economy too. You've got to have brakes and an accelerator. The tariffs are a brake. The reason Trump's so anxious for this bill is because it's the accelerator, and he wants to kind of juice the economy because of the brakes that the tariffs are putting on it. That's basically Tax Law 101 for you right now when it comes to the new tax bill, but stay tuned because I will update you as this tax bill changes, as it certainly will.